Something big is happening right now, a multi-trillion-dollar technological tidal wave that will redefine global business, the rise of generative AI. This isn't just about chatbots, it's about the massive physical infrastructure required to power them. Hidden beneath the hype surrounding chip makers, one legacy tech giant is quietly attempting one of the most audacious, high-stakes pivots in corporate history, positioning itself as the critical power grid for the AI revolution. But is this move an all-time strategic masterstroke or an existential bet that could pressure its very foundation? This company has always been known for its enterprise software, the rock-solid databases that run the world's financial institutions. Most investors don't realize this old-guard business is now challenging the mega cloud providers like Amazon and Microsoft on their own turf, specifically in the infrastructure as a service market. They are uniquely positioned to win big AI deals because of their specialized, high-performance cloud architecture. The short-term market reaction has been volatile, swinging from euphoria to extreme panic, but the long-term potential hinges entirely on a single, massive, and highly uncertain contract. By the end of this deep-dive analysis, you will understand the strategic significance of their cloud infrastructure, OCI, and its competitive advantages. A clear breakdown of their latest financial highlights, including the alarming surge in capital expenditure and a key metric called Remaining Performance Obligations, RPO. The profound concentration risk associated with their largest AI deal, and how to interpret these numbers to form your own balanced investment perspective on the company's future. As always, please remember, I am not a financial advisor. This is not financial advice. All information presented is for educational purposes only, compiled from publicly available data sources. Investing in the stock market involves risk, and you should always conduct your own thorough due diligence before making any investment decisions. If you find this analysis helpful, please take a second to hit the like button. Subscribe to the channel for more high-retention, high-quality stock research, and let's aim for 500 likes on this video to support the channel's growth. The company at the center of this AI infrastructure debate, the one making the multi-billion-dollar bet on the future of computing, is Oracle Corporation, traded on the New York Stock Exchange under the ticker ORCL. Oracle is a multinational computer technology corporation based in the United States, specializing in developing and marketing database software, cloud-engineered systems, and enterprise software products, most notably its cloud infrastructure, or OCI. Oracle operates primarily in the broader software and cloud infrastructure industry. While its historic business is high-margin enterprise software, SaaS, its growth narrative today is dominated by its infrastructure as a service business, OCI. The IaaS market matters now because generative AI models are exponentially more compute-intensive than traditional applications. Training and running models like ChatGPT requires massive clusters of expensive specialized hardware, specifically GPUs, and a high-speed network to connect them. OCI's fundamental role is to provide this power grid for the world's most demanding AI workloads. As a legacy player, Oracle is using its deep enterprise relationships and its unique cloud architecture to secure major contracts, essentially becoming an indispensable specialized contractor in the AI build-out. Oracle Cloud Infrastructure, or OCI, is the core product driving this new strategy. Its competitive advantage centers on two key areas: price performance and low egress fees. OCI is aggressively priced and designed to offer superior performance for specific workloads, particularly Oracle's own mission-critical databases, making it attractive for enterprises migrating to the cloud. They also charge significantly lower data egress fees than competitors, a critical factor for companies dealing with massive amounts of data. Specialized AI infrastructure.
OCI has designed high-bandwidth clusters, known as superclusters, specifically for large-scale GPU computing. This architecture is what has attracted massive deals, including a reported $300 billion five-year commitment from OpenAI, which is a pivotal part of the global Stargate project. This deal, which represents 1/3 of Oracle's entire backlog, is a clear milestone that has fundamentally transformed Oracle's business profile.
Now, let's break down the latest financial picture, which has utterly spooked the market and created the current volatility. Oracle reported total revenue of $16.1 billion, which represented a respectable 14% year-over-year growth, but still slightly missed analyst estimates. While that top-line number was fine, the market was focused on the breakdown. Cloud infrastructure, IaaS revenue, grew 68% year-over-year. That's a phenomenal growth rate, but for investors banking on an AI explosion, it was still considered lagging against sky-high expectations. What truly dominated the conversation was the spending. Capital expenditures, or CapEx, the money Oracle is pouring into building its AI data centers, hit roughly $12 billion in the quarter, 3 times the amount spent the previous year. This immediate massive cash outlay pushed the company's free cash flow, or FCF, deep into the negative, around negative $10 billion for the quarter, the financial pain point that worries debt holders and value investors. Furthermore, management substantially raised its full-year CapEx guidance to $50 billion, cementing the fact that this AI pivot is a long-term, capital-intensive commitment. The paradox here is the remaining performance obligations, or RPO. This key metric, which represents the value of future revenue from signed, non-cancelable customer contracts, soared by 438% to a staggering $523 billion. This huge backlog is the bullish thesis. It shows massive, committed future demand, largely tied to its major AI cloud contracts. But this RPO is funded by borrowing, pushing the long-term debt to approximately $100 billion and raising questions about its credit rating. Interestingly, Oracle did beat on adjusted net income, reporting $2.26 per share, though this was boosted by a one-time gain from the sale of its interest in the chip company Ampere. In essence, Oracle is officially transforming from a mature, high-margin, free cash flow positive software company into a high-growth, high-capex, infrastructure-heavy business. The financials reflect this jarring transition, massive future revenue backlog, but the immediate cost is a significant drain on cash and a surge in debt.
Being balanced is key. Oracle's biggest risks are acute. Concentration risk, the OpenAI factor. The massive RPO is heavily dependent on one or a few hyperscale AI clients, most notably OpenAI. If the AI ecosystem's growth slows, or if this major client falters or cannot meet its long-term financial obligations, a huge chunk of Oracle's future revenue and the capacity it is building to support it could be at risk. This is the single largest fear driving the recent stock pullback. CapEx strain and negative free cash flow. Raising the CapEx forecast to $50 billion for the year means more borrowing, more debt, and continued negative free cash flow in the near to medium term. Investors are worried that the financial returns on this infrastructure investment may be too slow to materialize, or that the cost will exceed the eventual profit margin. Execution and supply chain challenges. Building vast, specialized data centers on a global scale, particularly with high-demand GPU components, is fraught with logistical challenges, supply chain delays, and escalating costs. Delays could push back the monetization timeline and further strain finances. Competitive pressure. Oracle's OCI is still a distant fourth to AWS, Azure, and Google Cloud. While OCI has technical advantages for certain workloads, the sheer scale and comprehensive service offerings of the Big Three remain a significant competitive hurdle for mass market adoption.
But the upside is as large as the risk, focusing entirely on the long-term vision. Oracle has positioned itself to play a pivotal role in AI infrastructure. The total addressable market for AI infrastructure is forecasted to grow exponentially, and by securing multi-billion-dollar deals with AI pioneers, Oracle is staking a claim on the most exclusive and profitable end of the cloud market. Their specialized high-performance OCI architecture, built for efficient GPU clusters and lower egress fees, is a true competitive advantage for these demanding AI workloads. This is all evidenced by the massive long-term backlog. The $455 billion RPO, even with concentration risk, is a testament to the sheer scale of future revenue locked in. This provides a level of visibility and predictability not seen in many other hypergrowth tech stocks. If these contracts convert smoothly, the revenue growth will be transformational, with management targeting OCI revenue to reach as high as $166 billion by fiscal year 2030. This rapid expansion is also amplified by their sticky enterprise customer base. Oracle's existing software clients are a massive runway for their cloud business. Integrating their high-margin enterprise software like Fusion ERP and HCM with their own cloud infrastructure is a full-stack approach that locks in customers, embeds AI into applications, and drives high lifetime value, creating a powerful ecosystem. Finally, the long-term potential hinges on margin expansion potential. While the current AI deals are thin margin due to the massive initial investment, analysts and management project the new AI infrastructure business could eventually operate at a healthy non-GAAP gross margin of 30 to 40% by FY30. As the massive CapEx build-out slows down and the revenue conversion accelerates, the operational leverage from this infrastructure could drive impressive profitability and cash flow.
This is a classic grow now, pay later story that requires investors to zoom out. Does your risk tolerance match this kind of stock? Oracle is no longer the stable, slow-growth database company of the past. It's a high-growth, high-debt, high-capex, volatile play on the future of AI infrastructure. It requires a willingness to withstand significant share price swings and a strong belief in the long-term execution of the AI pivot over the next 3 to 5 years. Are you looking for stability or future upside? If you prioritize near-term free cash flow and dividend safety, the current financials are alarming. If you prioritize the chance for multi-bagger returns driven by a multi-trillion-dollar industry shift, Oracle's AI gamble is one of the most direct and leveraged ways to play the infrastructure side of the AI boom.
Oracle's stock is currently a battleground between short-term financial anxieties and long-term technological vision. What makes the stock interesting is its bold, early, and massive commitment to the AI infrastructure market, securing a colossal, industry-leading revenue backlog through its specialized OCI. However, the risk is the substantial negative free cash flow, the surging debt load required to fund the $50 billion CapEx, and the critical reliance on a few key large AI customers. This is a high-risk, high-reward stock that is absolutely worth watching as a key barometer for the entire AI infrastructure landscape. Once again, this is not financial advice. Please do your own research, consult with a professional, and understand your personal risk tolerance. If you enjoyed this in-depth analysis, let me know your thoughts on Oracle's AI gamble in the comments below. Like, comment, and subscribe for more balanced professional market insights. Thank you for watching, and I'll see you in the next one.